Hello. We are going to start, but please, casual. It's a casual Friday afternoon seminar, so feel free to. Hello? Better. Okay. Okay. I'm going to restart that. Hi, everyone. My name's Angie. I help run the New Ventures BC competition presented by Innovate BC. And we are just at the final stages of our
Going off again.
test. Okay. Okay. So, again. Third time's the charm. Okay, here from New Ventures BC, presented by Innovate BC. This is just the final stages of our annual education series to support early stage tech startups. And this is actually kind of the third in a series of financing talks we have done. And they're all, well, there's always a little bit of overlap. They all are slightly different. So we did one recently on shred credit, another one on general financing, another one on different investor types, another one on pitch deck. So this is a bit more of a deep dive into the difference between equity financing and debt financing. And this is both a new partner for New Ventures BC, National Bank. We have like the most complimentary acronyms, NVBC, NBC, which I love. But also, National Bank is relatively new to the Vancouver, BC market and are looking to meet and engage with more people within the ecosystem. So we're very happy to have National Bank on board. And this particular topic, debt financing versus equity financing, I was speaking to Walter here, who's a volunteer in the competition earlier. It's a newish topic for us, often because equity financing is, debt financing is often considered for later stage companies. However, I was talking to Mathieu and National Bank about this, and they said, well, there's actually some stuff that startups should know about and some interesting nuances. So I'm very happy to add this talk to our roster today. So I am going to thank my sponsors and then do a little housekeeping notes, and then I'll pass it over to Mathieu to introduce himself, National Bank, and get started. So our title sponsor is Innovate BC. Gold sponsors EY, Fasken. Thank you, Fasken, for always hosting us. SFU Beauty School of Business, National Bank, of course, UBC Cider School of Business. Silver sponsors are TELUS Ventures, Volition, Vantech Angel Network. We also have lots of wonderful bronze sponsors, Web Names, VEF, Ace Tech, Angel Forum, Backstretch Recruitment, and RBCX. And my only housekeeping note here is that we do have a pretty fair audience online, and there's nothing worse. You've all done it. Been watching an online webinar and not hearing anything. So we're going to use mics for the seminar. I'm going to replace that mic that doesn't work, and I will use that for any Q&A you have here in the room. Otherwise, I'm going to pass this back and we'll get started.
Unmute. There you go. Everybody can hear me. So good afternoon, everyone. First, I think I'm going to introduce myself. My name is Mathieu Apuzzo. I work National Bank in the Tech and Innovation Banking team. We are a commercial banking team up to corporate banking team. We support from startups to IPO within our group. We have a team of 5 in BC, which we started just about a year and a half ago. But we've been pretty present in the Toronto and Montreal market for quite some time. So we're really excited to be in the BC market in Vancouver. and I'm happy to be here for you with you guys today. I have my colleague here at the back, Wade, as well, that you probably all saw come in a little earlier. Sorry for being 3 minutes late this afternoon. But before I start, I want to get an understanding of who's in the room and what experience you all have with debt and equity. By just a show of hands, how many of you have experienced at some point in time in either your professional career or perhaps a venture you had before where you had to make a decision between debt or equity? Yes, raise your hands. One, two, three, and the rest is maybe so, no, not sure. Let's go with no. Raise your hands. Okay, lots of no's. Well, I think today the answer is going to be a big it depends. What is the best situation for you? And I hope that the takeaways that I'm going to leave you with are with some elements that are important for you to take in consideration when making those decisions because the right answer isn't the same for everybody. So, let's go. Wow. Here we go. Maybe there we go. Whoop, yeah. So, agenda today, we're just going to talk about some summary about equity. I'm by far not an expert on equity. I do debt. I've done debt for the past when was 2008. I don't know. I don't want to do math right now, but that's what I know. But I think what's important for the discussions today is to actually have an understanding of some equity aspects and what's available in the market, because sometimes there is a mix of both products that are going to be interesting for you to know about. Um, Also, we'll talk obviously about debt instruments and what you should be looking at and considering. And finally, we'll discuss a bit more, what's the difference? Is there a difference? When is there a difference? And why should you care? So I think for everyone who's done equity rounds before, or perhaps has had a previous course about equity rounds, I've summed it up pretty simply. A traditional, I guess, equity round story for any startup where you have, friends, family, and I know the third F is odd, but they call it fools. That's the terminology. Seed, Series A to Series C. And I guess, each stage of your enterprise or your venture, you're going to have moments uh, and milestones that are going to determine when you're ready for your next round of financing. But in typical, and they're not always the same, but very typical, at the beginning when you're raising money from your network, uh, your personal own savings, uh, it's probably at a prototype stage. You have an idea, you want to develop it, you maybe want to bring it to market. Then at seed level, you may start getting your first clients. You may start getting a institutional VC in there, someone who can help you get to the next step, or maybe sit on a board, guide you. Typically, that's when we would see a seed stage. And then it starts getting interesting. Series A, the big series where that's probably where the biggest growth will come from. You got your clients, you got a good product market fit. Um, the proof of concept, product market fits, and is pretty much settled. Um, and you're aiming for growth. And then we got Series B and C, and there are other series you may hear of, E, G, E, F. To be very honest with you, I think there's a lot of letters you can get behind there. But for the purpose of just today and understanding stages and different stages of your company, we'll keep them simple. B, usually that's where you're starting to aim for profitability. You're streamlining operations, maybe leaning out, maybe finding efficiencies. You've got a growth VC in there, maybe borderline of private equity that has a vision for you, and you have a vision for the company and the next steps. And Series C, well, typically there's an official need. Either you're bridging to an IPO, you've got an M&A plan that you want to finance, uh, and then you got the specific either strategic or another type of VC that's going to come and fund that. And feel free if there are any questions along the way. I want this to remain interactive, and I feel free to ask questions, and I'll answer them as best as I can. But definitely the equity part is not my expertise. But we come by equity financing on a day-to-day basis for our portfolio companies as well. So what do you consider when you're aiming to get equity, right? So I try to lay it out in the simplest format where I think these are the considerations that you should aim for in terms of what's important, why equity, and the reason I put them this way is because later on I'll be able to compare them with debt, and I feel these five here have quite a bit of uh, differences with the debt. So cost, equity is high cost, right? I think everyone in this room perhaps knows that VCs have a high demand for return. Depending on the firm, they could go from 20, 30%, depending. They're putting high risk dollars in their enterprise. They don't know if they'll ever see the money come back. So high risk demands high return. What is the cost to you though? Well, the cost to you is the ownership. So at the end of the day, you have to define if you want 100% ownership in a business that's valued at X amount of dollars, or you are going to take a partner and 10x that potentially, but not own 100%. Perhaps you'll own 20, 30, who knows, depending on the structure that you end up with. So that's your cost. It's called dilution. So what I just informed you of is dilution, is when you go from a high percentage of ownership to a lower percentage ownership in exchange for dollars, but your potential for growth as you obviously get equity, you will be able to support your plan. Cash flows, well, typically equity, you have no obligations, right? You get money day one. There's no interest payments, no capital repayments. So basically, what's left? Well, pretty much the hope that you will go IPO one day and your VCs are very happy with you and they will get a payback for the money they put in. So this is the least amount of obligation on the equity part that you will have. There are strings attached, of course. There's always strings attached. But on a business perspective, you don't owe anything back for a determined amount of time, which leads to maturity. Usually it's an infinite term, which means there's no deadline or date on when the money's owed back, usually. So that's something I want you guys to think about. And yeah, so that means it's typically the most patient form of capital you could ask for. Tax, really quickly, I don't want to dwell into that too much, but because you shouldn't be making a decision based on tax, but it is noteworthy that interest payments are tax deductible. Dividends, they're not tax deductible to the business, but then there's a tax consequence to your shareholders. So really quickly, just an example. I know you all know what equity means, but I wanted to dwell a bit on what factors you should be considering. So if you're selling a portion of your shares, 25,000 shares, let's say you have total 125 shares that Fasken has subscribed for your company, then that represents, a 20% that you're selling. Uh, let's say that you had originally 100,000, 25 you sold. So technically now you own 80%, but your new shareholder has 20%. That's dilution. Other costs involved in that are legal fees. They're pretty expensive, but Faskin's the best. Thank you, Faskin, for for sharing this room with us today. Um, but and there are other factors too to consider. You might have a broker, not at the early stage, but they may happen at the later stage where they're helping you find your buyer and they help a transaction happen. Cash flows, well, there's, like I said, no contractual cash flow. Basically, you get the money day one and you use it, you spend it, you want to grow. So you hopefully do 10x and your shareholders are happy. No maturity date. Investors typically, in this ranges widely, but a fund life usually is 5 to 7 years. So perhaps if you want to have an idea of when a fund would want to exit, perhaps that could be an indication, but by no means does it mean that there's a finite date to the funds. Involvement. So here's the interesting part. When you do, sell shares, you will get a partner, and that perhaps means board seat that you'll have to give away, ownership involvement, meaning you'll have to get on meetings with them regularly, tell them about your business and how your business is going, so they will get involved more closely. Uh, just types of instruments that I wanted to put there just to help ease into the next topic. So common shares, typically, no finite date, easy, you're giving away voting rights. Preferred shares are exactly what they mean. They're preferred, so it means they're ahead in terms of claims of the company and ahead of the common shares. Usually no voting rights, so they don't get to vote or get a board seat for any way, shape, or form. What you may hear a lot at the early stage is the SAFE, the simple agreement for future equity, and warrants and options. So these are the two that I want to maybe expand on a little bit more. So warrants are options to buy shares of the company. They are, and the reason I'm talking about them is because sometimes they're included in debt instruments. And that's where it gets maybe a little bit complicated. And to give you an idea of what a warrant is when you give a warrant to, say, a debt partner or any partner for that matter, you're giving them the right to buy. You're not giving them shares they want, but you're giving them the right to buy. So what does that mean? That means that at date X plus 10, for example, at a later date in time, if the share value has increased, what do you think will happen to that contract? Anybody sophisticated, knows warrants well, wants to perhaps share with everyone? No? Okay. Yeah? Exactly. They will exercise the right because the option is going to be in the money. That's how we say it in finance. It's in the money, which means, for example, let's say your share was $20 at day one and is now $50 at day two. They will exercise because they just made a $30 gain on that contract. So really simply put, it'll be done on the same day. They'll buy the share on the same day at $30 because they have the right to, and they will sell it at $50, so they made an immediate gain of 50. Simply put, that's what a warrant is. And if it's not in the money, well, it's an option, right? So you don't need to transact. A simple agreement for future equity is something that you might come by with investors where, let's say, you don't get along on a valuation, or it's difficult to evaluate your company because it's maybe earlier stage, or I don't know what reason that may be, but we see them often. It's basically pushing the can further into defining a value for your company. So what that means for you is that, let's say you get $100,000 today, and you're going to be giving that in equity later to your shareholder. Mechanically, how that works is you give let's say he gives you $100,000 today, and he's going to negotiate a discount on the next round. So the next time you go to your equity raise or your partners or whoever, and you raise equity at a certain valuation, he will get a discount on it. This is a good thing because you got money X minus a few days ago, but at the day you're going to raise equity, you might have to, negotiate, well, not negotiate, but you're going to have to give away some dilution at a discount, and your new shareholders will have to be aware of this. It happens often, it's typical, but it's noteworthy, and you have to consider the impacts of your future raise with that. So again, both are dilutive. I think that's the conclusion. So debt, now the part that I know more about. So similarly, the types of debt, they kind of vary with the the trajectory of your business and the stages of your business. But traditionally, you start with your personal money, your personal loans. You invest time and money into your company at the very early stage. Then after, you always and should always go to the government and see what they can give you. That's your next step. All the time, try to get free money. That's the number one thing to think about after you, the government. They're there to help, and there's a lot of grants for innovation in the space, so don't discount that. Then, well, you might start getting assets. So either you're an asset-light business where you're doing a lot of R&D, where you get tax credits. That's an asset, that's a receivable. You can finance that. There are players that finance that, banks, specialty lenders too. Or you're an asset-heavy business where you're going to start needing to buy, maybe you're in the, I don't know, hosting business, you need to buy servers. Maybe you're in the robotics business and you need to buy equipment. So asset equals financing. You can finance hard assets. Then after, I would say, when you start, getting contracts and sales, well, there's receivable financing, there's contract financing, there's EDC is a great partner to have international contracts where you need to finance those. Those are a great way to finance assets. Those are assets. The receivables are contracts. And then obviously, like I said, shred tax credits. Then I would say a good thing to think about is maybe venture debt. When you get your first institutional VC, venture debt is a possible solution for you. It is a form of financing that comes subsequent to an equity raise, typically a percentage of your equity raise or valuation of the company. And usually you see this in the seed or Series A level. So a little further out, but still possible for young companies. And it finances growth. And the last is when you become a company and you start generating cash flows, you can start, asking for loans, just general loans. Helping you out here a bit on the stage, I have this slide that, kind of helps you. What type of financing can you expect based on which, more the stage. It's not always an exact science, but I think it should give you a good indication of what's possible. At the startup level, definitely small, maybe operating line of credit if you have receivables, possible R&D tax credit financing, government grants and loans. Then on the growth stage, where you have maybe some institutional investor, we're talking about SaaS lines, extended R&D tax credits, venture debt, mezzanine or junior debt. There's partners out there that do that. And obviously government grants and loans as well. So here, the debt considerations, the same 5 we had before. And then I'll have them side by side so it's easier to see. Cost. Usually loans, debt is a lower cost of capital than equity, usually. We're talking about, I don't know, well, today's not, it's pretty high. We're talking, when prime's at some 7%, you probably are talking about loans at the 9, 10 level. But traditionally in a more expansionary uh, economy, let's say you're probably looking at cost of, capital debt more around the 6 to 8%. That's would be on the more senior side, so bank. And then there's other types of lenders that I'm going to get into. But you see already we're talking about much lower than we talked about before, where your shareholders will invest in a company high risk, high return, I said. And I also said they probably demand returns of 20 to 30%. And on top of that, you're giving away some percentage of your company. So already we're talking about much different type of cost of capital. Cash flows, well, when you're taking debt, you owe it back. There's always a finite date. Always, 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 and always have to consider that. And I'll get into more details on what you should be considering with that when you take on debt, but there's always a date. It's not super startup friendly. It's not growth friendly because intuitively, a growth company wants to reserve as much capital for the growth of the business. So if you have to start owing money back in interest or principal payments, you have to measure how much is that going to be and how much is that going to impact your cash flows. So in the end, it could impede your growth. So consider those when you're taking debt. I said maturity, tax, like I said earlier, do not make a decision on that, but it is noteworthy. Interest is tax deductible, right? The involvement is different. So you are going to have to deliver to your bank some documents. You're going to have discussions with your bank on how performance of the business is going. However, your banker does not sit on your board. He doesn't walk into your office every day of the week to see how you're going. Not that investors do that, but just to give you a good idea of, the involvement of a banker. The banker will want periodical news from you, but it is not as much of an involvement that an investor would require. And one point that I want to note is if you're not meeting the obligation of your loan agreement or the debt instrument, it can actually lead to company failure, to, an event where your company might go bankrupt because you can't owe the money back. So debt is risky. It's cheaper, but it is riskier for the entrepreneur. So different types, you've got term loans. Usually they have a term as defined by the name. You have lines of credit. Usually they're more flexible, but banks on lines of credits, can demand repayment at any time, depending on the type. Then you have junior mezz debt. That usually is the more patient version of debt, where you have some players, some specialty players, where they will give you loans that don't have repayment for a certain amount of years. Maybe that's 2 years, maybe that's 5 years, maybe that's 8 years. And those types of debt instrument may be more friendly for a startup. And then you have convertible debentures. So that's an interesting one. So that's a debt instrument in nature because it has a finite date, maybe even has interest payments. But the difference is the holder of that debt has the option to convert it to equity. So is that equity or is that debt? Oh, it's somewhere in between. Whoop. All right, I just went way too. There you go. Okay. So what should you be considering when you have debt in front of you? What questions should you be asking? Well, let's first take a look at, the main themes that I think are important to gather. So you've got your financial situation, that's one to consider. Your risk appetite, control that you want to have on the company. And I think market conditions are important too. So first, your financial situation. Well, where are you? What stage are you in the company? What are you financing? These are all questions that you should be asking yourself. Uh, and when you've answered that question, how could you repay the loan? So let's say, for example, you are financing Shred, just as an example. So Shred, you file at the end of the year. The government owes you a certain, let's say, $500,000. Well, you know the government's going to pay you and give you that at a certain amount of time, probably, I don't know, 6 months after year end, or probably a little bit more, 6 to 9 months after year end. You can finance that and you know how you're going to repay it back because you know you're going to have cash coming in 9 months. So you know that the loan that you take out for financing Shred day one, you know the government's going to pay you at a certain point in time for those shreds at a certain date. So you've got that question answered. I know how I'm going to pay back my loan. So you have to always wonder how that's going to happen. If you're going to take venture debt as an example, how are you going to pay back that loan? Well, typically it's going to be with equity, your future round. Asset-backed lending, how are you going to pay back that loan? Well, hopefully you're looking to become profitable after buying those assets and you could start generating cash flows and you're going to pay down that debt. Always ask yourself how you're going to pay it down. Risk appetite. So I said earlier that debt is risky. And I've mentioned that why it's risky, because if you do not meet the obligations, the bank or lender could technically say, hey, I want my money back. Doesn't happen overnight like that. Trust me, there's a lot of discussions that take place, but it's something to consider. Debt is riskier. You have to pay it back at some point in time. We're loaning you money. It's a loan. So your risk appetite is important in that as well. I'd say also maybe the industry that you're in is important as well. What are your peers doing? Are you in a business that is very high capex intensive? If you are, what are your peers doing? Are they financing it with debt? Probably, maybe, maybe not. Are they even financeable types of assets? So these are things that you need to consider as well. If you're the type of person that feels comfortable with debt and you're going to repay it because you have a plan, then perhaps your risk appetite on debt is higher than someone else who doesn't know how to answer those questions. The control, well, when you have an investor that's involved in your business, you're letting go of something. You're letting go of ownership. You're letting go of voting rights. You're letting go of a board seat. So that means someone is going to come and help you make decisions. And at some point in time, maybe not at the early stage, but at the later stage, you will have enough investors with a lot of voting rights, and they could potentially make decisions for you. You're going to be CEO, but you won't be majority shareholder anymore. So that's something to consider as well. Sometimes that could push a bit the ownership dilution for a bit. And that makes sense, but that only makes sense if you know how you're going to pay it back. And market conditions. So market conditions are important because, for example, today we're talking about prime is at, losing count. I'm a banker, but I should know this, 25 basis points above 6.7. So we're at 6.95. Thank you, Wade. We're at 6.95. So that's 7% now for the let's say the prime clients, the clients that are very low risk. That means we are looking at probably the higher risk loans to be around the 9 or 10%. That's considerable. Those are high interest rates. Maybe you're going to want to take equity instead because paying, let's say, $1 million loan, 10%, that's $100,000 a year of just interest. So maybe it's a good time to take a bit more equity, a little less debt. Maybe. But then there's also consideration about your space. Maybe your in the clean tech space and things are going really well, investors are basically throwing money at you because you have a solution that will save the world, then I think you should take the money and run, take that equity. But maybe you're in a space where it's a little harder. Maybe you're in a hardware space. Investors are having a harder time to understand, hardware and the components that are involved in it. And perhaps there's less appetite, so you're going to be giving more dilution. Perhaps maybe consider a bit more debt in that aspect. So market conditions are important. So basically, I'm coming back to what I've talked before, when is, the cash flows and why we do it and the fact that you have to repay it. And then I want to help you decide when is a good time to consider debt. Well, for sure, when you have positive cash flows, it's a great time to consider debt because you have a definite reason and a definite ability to repay the debt. So that's definitely, I would say, no questions asked. You should consider debt. If you can reach profitability by scaling back. So a lot of asset-light businesses only require some good marketing and some great salespeople. And in a market where you won't see as much growth, you can scale back maybe, and maybe you can see profitability or neutral. That's a good consideration for debt as well. Types of assets, like I said, if you have fixed assets, it's a great way to consider debt. And always think about when you'll be repaying it. Basically, that's the conclusion to when debt is a good option. Now I want to take you to some external factors. So those were more internal, these are external. So there's also other reasons why you should be considering debt. Well, consider when, you're an expansionary market. I was saying interest rates are high now. Maybe that's not the best way. Your industry perhaps is not favorable right now for the equity markets because of multiples. That's another reason maybe to look at debt. And obviously the competition. Always look at the competition. What is competition doing? What I was told once is that the fast eat the slow. Not the big, the small. The fast they eat the slow. So if you're fast enough to market, you get the equity, you get the debt, you can grow faster than your competitors. Those are the winners. So is debt and equity always clear? Well, the answer is there, but I want to tell you why. No, it's not. So just to bring you back to where we were before in terms of 5 considerations, I've changed a bit the language and I've said, well, equity cost is higher, debt is lower. Cash flows, well, you have the least obligations and then you have the most obligations for debt. Maturity, it's long or infinite, and debt, well, you have a shorter term. And involvement, more and less. And here, well, these are other things you've got to consider. This is what I want you to look at when you're looking at transactions, when you're looking at a deal, when you're looking at an offer. Reporting requirements. Those you're going to need to report in any case. Either you got a phone call or a board meeting with your equity partner, or if it's a debt that looks like equity, which I'll get to, well, you'll definitely need to report. And banks, you'll definitely need to report. So that's probably not a consideration I would ever put as a top one, but it is something that you have to consider. Covenants. In equity, you'll have less covenants. So it is rare that in an equity contract, there's going to be someone that's going to tell you, well, you have to meet these targets or else I want my money back. That's what debt looks like. Equity, you'll have less obligations for that. Security, typically equity has no security. So you don't have to sign a general security agreement on your assets. Equity usually doesn't do that. It leaves it to the lenders, which basically means if you are signing security on your assets, it basically means that you're giving away ownership of the assets to a lender, which is typical. You'll always have to do that if you're lending money. If you're financing assets or like equipment, for example, you'll have to provide that. But in equity, typically less so. Other recourses that you can consider, well, sometimes you might have to sign a personal guarantee in certain situations. And in equity, that's never the case, or very rarely the case. And in debt, well, you may have to. So recourse is important to see what your involvement is that in the agreement. And negative covenants. So I put negative covenants, but there's also terms called positive covenants. So really simply, positive covenants is what you have to do, what we're asking you to do. Negative covenants is what we don't want you to do. But just consider them both in this category. It's we want you to do something or we want you not to do something. In an equity contract, very rarely you will have many of those. It's more on a, I would say, expectation basis. It's never written down that we want you to reach this ratio by that date, or we don't want you to do any acquisitions, or we don't want you to do any fusion with any of your subsidiaries, for example. In debt, you will have lots of those. So those, you'll have to consider each one of them. So they're important to look at. So what should you do? Well, I want you to understand that debt and equity is not black or white. It's not yes or no. It's not wrong or right. It's everything in between investors, which is the typical equity you know about, common shares, all the way to your typical banks. Everything in between exists. So, for example, we know I want you to notice that the banks are at the utmost left side. So that means that the obligations are the highest and the cost is the least. But banks are also starting to play a little bit higher up the grid. Why? Does anybody could tell me why? Or maybe I've mentioned something earlier about venture debt that maybe I've mentioned something about the options to buy something else. Anyone? Yes. Yes. So that's a good one. Convertible debt. But banks don't do convertible debt. But that's a good thought process because, yes, it's right in between. But I'll show you where that would be. That would probably look somewhere in between this. But I'm looking at somewhere in between here. Anyone wants to try?
Armin Online says to tap into new markets.
Which one?
To tap into new markets is their guess.
Not quite. Warrants. So banks are taking more and more warrants attached to earlier stage loans. So what that means is they'll lend you, let's say $1 million venture debt, and then they'll say, well, we want to take 1.5% warrants, which means 1.5% of $1 million is 150,000, 15,000 shares. And then that becomes an option to buy shares. So then you're starting to look a bit more like an equity piece. So banks are starting to get there, where earlier stage funds, they're getting an equity piece to it. Another thing I want you guys to consider is that, and gentlemen, what's your name? What's your, no, behind with the convertible debt, sorry.
Oh.
Sky, so he mentioned convertible debt. So convertible debt is an investor that wants to look more like a bank, simply put, not really, but simply put. So it's saying, I will lend you $1 million. You owe it to me by year 3, but I have the option, similar to a bank, I have the option to convert it to equity. So that starts to look more up the scale here. So you will find all shapes, all types of instruments throughout your professional and your entrepreneurial career. Yes, good question. That's asset backed. So that typically you will find that here. You'll find that in banks. Sometimes, depending on the nature of the receivable that they're buying, if the nature is a bit more risky, you might find that on the specialty firms that, they'll do that as well. But typically, specialty firms are a little bit more expensive, uh, but obviously less obligations. So you will come across many types of documents, of contractual, of agreements. And it's important to consider all types, but it's also important to ask yourself a question: when am I going to repay it? What do I have to do to keep this in check so I'm not asked to be repaid early? What are my obligations? What are the cash flows that are involved? Are they high? Are they low? Because I need to keep the most cash for my business in order to grow. And they exist throughout the spectrum. So you'll have partners all across this line that will want to give you something that is something of equity or something of debt. And that's it. So I don't know if anybody has any questions.
There's a couple here online. Feel free to
Yeah.
add more. This chart is a good entry for this. This is a more general question. Someone's just asking if you would consider national banks startup friendly, similar to Silicon Valley Bank was.
Yes. So similarly so Silicon Valley Bank, as you all know, was a very, for those who don't know, well, I'm going to say very startup friendly bank. Uh, it's unfortunate what happened. I think, they were partners of ours as well. We used them occasionally on some transactions with them. And National Bank is looking to be the SVB of Canada slowly. So yes, we're working there. We're working towards there. We are startup friendly. We are starting as well, obviously out west. We're a small team, but yes, that to answer your question.
I've got one more online, and then if anyone wants to ask here. Uh, you may or may not be able to answer this. This one's from David. He's talking about the 30% investor tax credit that BC offers.
The what? Sorry.
The investor tax credit BC offers, the EBC
Oh,
one.
yeah. No.
You don't know that one well? Okay, then maybe I'll save that question for another
Yeah,
time.
I'm aware it
Yeah,
exists.
okay.
There are similar ones that I'm aware across the country as well, but I don't think I'll be able to answer it in an effective way.
Okay, that's fine. David, I'll pass this along to like EY or someone like that and try and get an answer for you. All right. Anyone in the room?
Yeah.
Over here, I'm gonna use the mic so I don't have to type the question.
Thank you. Is there a particular ratio when you're mixing equity and debt in terms of how an investor VC will look at how much debt is on your balance sheet and that, startups and ventures should be careful about?
Absolutely. Yes, there is, but um, take my answer and say it as maybe a benchmark, but it varies quite a bit. I'll say most VC-backed companies, early stage, we'll talk about the seed to Series A level, because it varies throughout the ventures, I guess, milestones. But at the very early stage, you're talking about 20% of the valuation of your EV. So whatever your investors have invested in you in terms of the valuation that you were able to realize from that round, usually 20% debt is not unheard of. Obviously, that rises through time. So, for example, I have a client that does M&A, and he's, EBITDA positive. He's in the 30 million of EBITDA, and we finance about 60% of his value. So it does grow with time. as your business becomes less risky, of course.
Just a question from online. Do you recommend startups with good sales raise more money with debt versus giving away equity, and at what stage?
So if you have sales already, I'm assuming you have some receivables, you probably have some expenses. So my first guess is definitely start talking about a line of credit for your receivables. Start talking about definitely a shred uh, tax credit financing. That's 100% something I would do. If you're not funded by a VC yet, maybe venture debt is not in the picture for you, but that doesn't mean that a BDC or any government type entity will not lend you money. I would consider that any government money that you can get it. Um, so the answer to your question is yes, you should consider debt at any stage. You should consider both at all times. The level will depend on all those factors that I discussed. So that was, when are you able to repay it back? If it starts to become convoluted or you're not sure, then maybe not consider debt. Um, the cash flows, the obligations, if you're starting to see that the obligations are larger than your rent expense, then maybe you should start considering equity. Um, Factors like that.
Yeah, we have an alumni company, Jane Software, that they had strong revenue. So pretty much all their equity was, at least in the earlier days, was debt. Okay, a couple more questions here. Unless put your hand up if you're in the room and you want to ask. What's the loan range for a growth stage tech startup?
A growth stage tech startup, loan range. It's a difficult question to answer specifically because growth stage can mean many different things. But valuation, look at your valuation. So that's something that you should look at. 20% is not unreasonable for growth stage. I'm assuming you're still burning money, so you're still reinvesting the funds into your enterprise. You're not profitable yet. Range in terms of dollars, well, it'll tech startup. I mean, valuations have moved a lot throughout the past 12 months, so I'm a difficult position to say that. Maybe someone in valuation should be better positioned to give you that, but 20% is not unreasonable.
Okay. Another one from online. How does National Bank differ from EDC or BDC in its approach to lending to startups?
Yeah. So BDC and EDC, you should definitely always approach them. It's a government body. Their whole purpose is to help the ecosystem in the cheapest way possible. So, because that's what they are, they're government, they're there for that. They don't have shareholders to abide to. They don't have rules like banks do that they have to keep a certain amount of capital or ratios to maintain. So, putting that into perspective, they are much more flexible than banks. No question about that. Um, it'll depend. Sometimes they're a better fit, sometimes they're not. I'll tell you that banks are usually have stronger appetites when you have an institutional VC that's backed if you're an early stage and you're not profitable yet. So perhaps that in those regards, you'll have probably more of a tier one bank. And then maybe if you're a little bit earlier or don't have an investor or maybe just angel backing, maybe BDC is a better fit. But at the end of the day, we rarely compete. We are partners. Often you can get both. So we have a lot of clients that have a portion with BDC and a portion with us. And EDC as well as a very good partner we use across the country.
Does National Bank mainly support Canadian companies or Delaware companies? Are they on the
Good
list?
question. So National Bank is our main focus is Canadian companies, Canadian created companies. So as long as there's a Canadian office or Canadian employees, that's who we favor. We obviously have a lot of territory to gain across the country, so that is our focus for probably the next, I would say, 5 years.
Okay. And you said the V word, valuation, which means this question had to come up, which is what's the best way of getting a valuation for your company? In a very
Ah,
quick answer. Clearly, this could be a whole other topic.
yeah, so I'm not a valuation expert by any means. All I can give you is what I know, and what I know doesn't is only meant by what I've experienced. So I'm big disclaimer. How can you value a company? Well, you could get, a company evaluator to come and do a report and say, hey, you're valued X. But the way I put it is, it's the same way as an agent comes to your house and says the value of your house is worth X. It's great. He probably compared with, what was recently sold. But there's so many nuts and bolts and whistles that are specific to your company that when you're taking a deep dive, maybe that's not what a price you're going to get. So what I mean by that is market value is only what people are willing to pay for it. So you have to go to market. You have to raise money from an investor, from someone who's actually is willing to put money into your company. That's the best way to value your company, in my opinion. I would not waste money on a valuator if you've never had a raise. I probably just instead reach out to a few investors, and whatever comes your way, they're going to come with offers, and they're going to vary in valuation, and that should give you a good indication of what's it valued at. But that's my opinion.
All right. Yeah.
Yeah, how does the timeline look like when a company approach you to like they officially got the credit approved?
Yeah, so good question. It varies. But let's say something as simple as asset-backed receivable tax credit financing, we could get something done within 30 days, maybe 45 at most. If you're looking at more complex like venture debt, where there's due diligence with your investors that are involved, the valuation, we have to do work on that as well. There's a bit more work. So I would say maybe 8 weeks at most, 7 to 8 weeks.
Does National Bank do shred financing?
Yep,
You do. Okay.
yep, we do. Yep.
Okay. We're actually right on time. Last call for questions. We're good. All right. Well, thank you very much, Mathieu.
Thank you.
Good for the overview. Thanks, everyone. We're gonna have clap, please. So we are gonna do. We have lots of topics this year. So we have 2 more seminars coming up in July. We're going to do a MyTax webinar on the MyTax program, and then we're going to do one on financials. We've done all the financing. Great way to get financing is to have great financials. So we're going to do a talk on that in July. So we'll send out those days, that info pretty soon. Otherwise, that's it. Have a great summer if we don't see you. Thanks again for coming, online and offline. Thanks.